Imagine you're sitting at a table, staring at a deck of cards. You think you've got a foolproof way to win, but you're not really sure. That's kind of like how many traders approach the market without truly knowing if their strategy is going to pay off. So, let's take a look at how you can figure out if your trading strategy is going to work in real life. Now, the key to knowing if your strategy is going to work is something called backtesting. Backtesting is like running a simulation of your strategy, using historical market data. It's a way to see how your strategy would have performed if it had been applied to the market in the past. It's not the same as paper trading, but it's similar. Instead of using fictional money, you're using actual market data. Backtesting is crucial because trading is a high-risk activity. If you're not careful, you can end up losing a lot of money. But if you know your strategy's strengths and weaknesses, you can make better decisions and stay one step ahead of the market. So, let's talk about how backtesting works. You'll need to use historical data from a financial market like the stock charts of a company. Then, you apply your trading strategy to that data, using software or a spreadsheet to automate the process. The result will be a report that shows you how your strategy would have performed in real-life market conditions. That information can give you valuable insight into what works and what doesn't. However, it's easy to misinterpret the results of backtesting. Let's say your strategy seems to work like a charm when you run a backtest, but the problem is that the quality of the data you're using affects how accurate those results are. If the market data you're using is incomplete or inaccurate, the results might be misleading. And if you use low-quality data, you might end up with a strategy that sounds perfect, but has no real-world application. Another mistake beginners make is to only backtest their strategy on a single asset, or on a specific time frame. But markets are complex, and what works on one asset might not work on another. To get a more accurate picture of your strategy's performance, you need to backtest on multiple assets and time frames. Here's how you can try this in practice. For homework, take the chart of a randomly selected stock on your favorite online trading platform, or a spreadsheet, or even paper trading journal for that matter. Develop a simple trading strategy based on a moving average cross. Then, use Excel or your preferred backtesting software to see how your strategy would have performed over the last 6 months. Try to make sure your backtest covers a sufficient sample size of at least 6 weeks for the strategy to be reliable. When you're reviewing your results, pay special attention to any false breakouts or premature reversals that might be misleading. You want to make sure your system isn't looking worse than it really is. Finally, don't forget to check your backtest for these 2 common issues first. Look for over-optimism. Are you only seeing good results because your strategy was developed and backtested on the same data that you are looking at? Or are you really testing it with a separate piece of data, like a walk-forward optimization? Second, are your results being artificially pumped by your choice of data? Maybe you're backtesting over a specific short period of time where your strategy performed exceptionally well, or maybe you're not testing your strategy over different market conditions. Always be careful about over-optimism and make sure to test your strategy in a variety of markets. In our next lesson, we'll be taking a look at walk-forward optimization and how it can help you avoid the pitfalls of over-optimism. Don't forget to subscribe to our channel and hit the notification bell for more trading lessons like this one. And remember, trading without knowledge is a guaranteed way to lose money.